Hey fam, today we are talking about some strange, creative on-chain derivative stuff which is going around. Like every dog token is being backed by a perpetual, a protocol which stays on because traders keep on losing money. And what kind of infrastructure is powering all of these? If you want to know more, let's jump into it. Welcome back to Block Talk.
I will fire Gary
Today we are starting with actually alt.fun. So give me one sentence pitch about that and what actually is this about?
Okay, so alt.fun is a token launchpad, actually a meme launchpad on HyperEVM. But instead of pairing a new token with a stable coin or another token, the underlying asset here is tokenized perhaps like what to say, leveraged tokens. So every meme coin launched here is also an directional bet on the underlying market. Creator picks an asset. They can take any assets such as Hype, BTC, Ethereum, Gold, and take a direction such as 5x long or 3x short and keep it as an underlying asset for the meme token. And users here buy and sell with USDC. Simple on surface, wild underneath.
So walk me through what actually happens if I hit buy on one of these tokens, like mechanically what is going on in this?
Okay. So what happened over here is you send USDC to the protocol. The protocol takes those USDC, gives it to BounceTech, which is a platform where you can mint leveraged tokens. BounceTech takes your USDC and mints the respective leveraged token which was set by the creator. And that leveraged token, LT for short, goes into the bonding curve and you get meme coin in return. And while you sell the meme coin, the reverse happens. The meme coin goes into bonding curve, the leverage token is released, the leverage token is sold in BounceTech, and the remaining USDC which you get comes to your wallet.
Okay. So every other launchpad, like you have heard about pump.fun, right? The bonding curve is sitting very stable. So what changes when you reserve this leveraged token?
Okay. On a normal launchpad, token price movement comes from only one source, is buy and sell pressure from traders. But here there are two sources to happen, like trading activity and the performance of the underlying leveraged position. So let's take a scenario where the token is not having any buy or sell from traders, but the token had an underlying position of Hype 3x long. So if Hyperliquid's token performs 10% on the day, Hype 3L will perform 30% and the meme coin's price will also rise 30% without any movement in the market. Same goes for like opposite positions also. Even if nobody sells the meme coin, but still the underlying asset depreciates, the token's value will go even further down.
So you said graduate. So what does it mean in alt.fun's context?
Okay. Here the graduation threshold is $9,000 in curve value. So once you hit that much, like $9,000 worth of liquidity token inside the bonding curve, the pair migrates to HyperSwap L2 pool. So the token / LT pair gets created on a DEX and it can be bought or sold on chain without the use of alt.fun.
Okay. So let's talk about what are the risks in this. So you mentioned about bounce stake. What is that and what does it rely on people on buying these tokens?
Okay. So BounceTech wraps a hyperliquid perpetual futures position into an ERC20. That's how you get a leverage token. So here the token is non-liquidating. You can't get margin called the way you would on a regular prep. But this also gets in as the disadvantage because leverage tokens lose value in three ways. One is wrong way price movement. Like if a token has clear momentum towards a particular direction, the leverage token will give you good results. But if there is volatility, like the underlying tokens, like here also we will take example of high 3L. 3L means 3x long. So if Hyperliquid rises 10%, this token will rise 30%. Then if Hyperliquid drops 10%, in spot, you gain 10, you lose 10. You are on the same spot. But while having leverage token, what will happen is, you will gain 30, but from that spot, you again lost 30%. And if you calculate this, we have an example over here. There is also volatility decay. So leverage tokens always rebalances to maintain its target leverage. I will explain you that. Like, let's take Hype 3L. If Hyperliquid performs 10% up, then this 3L token will perform 30%, right? And the next day, if Hyperliquid falls 10%, in spot you stay flat. $100 became 110 and you become $100. But what happens in leverage token is, your $100 will become 130 because of 30% appreciation. Then after rebalancing, what the next day, you would get 30% losses on 130. So if you ballpark, it's like 13, 26, $39. So 130 minus 39 is like $91. So here you are at a loss of $9 because of having a leverage token instead of holding in a spot. So if the market is volatile, leverage token will also lose its value. And third is funding cost. Like the leverage tokens is also backed by a preposition. So perpetuals pay or earn funding. So based on market forces, that will, if you are getting perpetuals, like you are getting the funding rates, it's well and good. But if you need to pay those funding fees, then you have also to take those losses. So leverage token loses value in these types of formats.
So you're saying like big picture take on alt.fun has been happening, and is this a good thing for the space? What do you think about that?
So the take is, this is creative, that's for sure. But here we are taking two unrelated asset classes, a meme coin and an underlying asset, and those two will have separate price actions, and we are forcibly trying to combine them. And I think that's not so great in long term. That's one thing. Another one is, but here instead of the underlying asset, like the leverage token is being used somewhere, right? It's not staying idle in the liquidity pool. So it's bold design. It's very exciting to see, and I guess this will also promote many other developers to come up with much more new designs.
Okay. In segment 2, let's talk about papertrade.xyz. So this one is genuinely a bizarre to me. So how does this even work first?
Okay. So PrepTrade is a synthetic preps exchange on HyperEVM. So the major features which they are saying is 1000x leverage, zero slippage and zero funding cost. And the mechanism behind it enables this. So how does a perpetual exchange function without slippage cost or funding fees? If you see the background of it, here the winners and losers of a particular trade are directly correlated. Like losers fund the winners directly, where no contract ever hits the Hyperliquid exchange order books, and the LP starts from $0 here. It does not bootstrap with any investor capital or such things. It fills purely from trader losses. And the winning trades also should pay some haircut. Haircut in the sense, it's like if you make small profits, you will have bigger commissions to pay. If your profits are larger, smaller commissions to pay. And from these mechanisms, the exchange functions and facilitates the movement of money between two parties.
Okay. So if you win big, the protocol is okay with that. Is that so?
Yeah. So the structure is designed so that large winning trades have small percentage fees, smaller wins, scalps, and tiny moves have a larger percentage taken. And this makes intuitive sense because the LP can absorb small payouts more easily. Big payouts that would strain the LP are somewhat offset by the lower fees, which keeps traders feeling they are getting a fair deal for their rare big wins. But and here they are having a design feature like if the LP, like the liquidity provider, can't pay a winner immediately, the payout goes into an on-chain FIFO debt queue. FIFO is like first in, first out, and gets filled when more losses come in. So at the start, you might win a trade and have to wait a little to get the loser's funds.
And then there is paper token, then that's where it gets very much interesting.
So here losing traders don't just lose their money, they receive paper tokens as a consolation mechanism. The lower the LP balance, the more paper you mint per dollar lost. So when the system is more stressed, the LP is thin, that's when you accumulate paper the cheapest. And paper has a feature. You can stake paper to get USDC dividends, a continuous cut of LP revenue. So at starting I said the LP takes haircuts from profitable trades, like those profits are being distributed with the paper stakers. And once the LP exceeds $5 million, all surplus gains directly go to paper stakers. So here there are two distinct states to track. If there is low LP, paper emissions are high, you get cheap paper. And if the LP is high, like if it has $5 million worth of value being captured, emissions are low, but whoever already got paper, right, they get high dividends.
So staking paper is basically betting that traders will lose. So which is, when you think about it, what do you think?
Okay. So this is arguably the one of the most reliable bets in finance, because if you see statistics, the house always wins over time, not because of rigged odds, but because most retail traders overtrade, over leverage, and don't manage risk. And this is also explicitly an on-chain bucket shop. The protocol is the counterparty, not the traders. So here, even like if you see Hyperliquid and GMX and all, they also have a huge LP. Like it will take a counter trade if there is no counterparty to take the trade. In a perpetual market, you always need two side parties. If you are longing, someone would will to short. So whoever wins will pay the other guy. But here the house, the website, the protocol is taking the side of opposite party, right? And this kind of mechanism is illegal in most jurisdictions because of fraud concerns. But this paper trade makes it transparent and on-chain. So I think it won't be allowed in any country soon, but being on-chain, people can see like what kind of trades paper trade is taking on.
Okay. So how do you compare this to the traditional PrepDex?
So in traditional prep decks, you are always trading against other LPs who are providing real capital or against an order book. In paper trade, you trade against the protocol or house. The 1000x leverage and zero funding sounds insane, but the house is still extracting on your wins too. So 1000x also means that you will fail faster. Like normally 30x to 40x itself is too much leverage. Like you can't handle that much. 1000x is like your trade will last, I think around 10 to 20 minutes, I guess, for your liquidation. So the house is actually betting that you would lose money. And this is not for serious directional traders. This is for degens. So that's how paper trade is different from traditional PrepDexes.
Okay. So both of these projects, alt.fun and papertrade, exist on HyperEVM. So and a lot of people are hearing this wonder that why now, why Hyperliquid specifically? So this is where we talk about HIP3 and HIP4. So what is it all about?
Okay, so for context, HIP stands for Hyperliquid Improvement Proposal, where the governance mechanism for expanding what the protocol can do. So HIP3 introduced native spot liquidity, essentially allowing builders to launch spot tokens that interact natively with Hyperliquid's on-chain order books. infrastructure and everything. So HIP4 opened up EVM pre-compiles. Like this is custom on-chain functions that let smart contracts to read hyperliquids. What I can say is, if you take an exchange, there will be like liquidation prices, mid-order book value. So there will be some 4-5 technical variables which you can get from an exchange. And if you are taking them via an API call, there will be some latency around it. But by using hyperliquid precompile, what you get is instant, like with sub-second latency, you can get those values and integrate those values into your smart contract. So this is the key unlock. Like before HIP4, you could not write a smart contract that opened the prep position on behalf of a user in a single transaction. So, but after HIP4, now you can. Like bounce check is a wrapper around precompile, which gets leveraged tokens. And even papertrade also runs on HyperEVM and uses the same infrastructure. Like the synthetic settlement and LP mechanisms are deeply tied to on-chain primitives.
So before HIP4, as what you said, was this not just buildable and
Yeah, it was not buildable. Like yet you can build a DEX on another EVM chain. You can run a prep on Arbitrum or Solana or somewhere, but you cannot natively embed a prep inside a bonding curve in a single transaction anywhere else. Like what does this mean is, if you ever wanted to do a prep exchange, you wanted to do everything from scratch. The clearing, the order book, the matching engine, liquidation, everything needs to be coded from scratch. But Hyperliquid via HIP4 has opened the tech to everyone. So you can use Hyperliquid's infrastructure and build wrappers around it however you like, without doing the same stuff again and again from scratch with huge teams. So this is a great unlock.
so what other doors does this open? So what is a natural step for the builders thinking about this?
So you have possibility of getting structured products. Like you could create ERC20 tokens that represent complex payoff structures backed by Hyperliquid perps. Native on-chain walls that run automated strategies using perps. Like think of delta neutral yield, basis trading, funding fee, scalping, etc. And alt.fun already teased this. One creator even mentioned wanting to port this model to Solana.
So before we close out, I want to mention something about Solana. That the Solana is getting some attention on pet markets too, independently with all the HyperEVM stuff. So what's actually happening here?
Okay. Solana's native prep scene always had Drift protocol, Zeta markets, Flash trade, and etc. But recently there has been renewed attention because Toli recently shilled a new exchange called Phoenix Trade. And Phoenix Trade had been building their exchange from past 6 months, I guess. And there is not any major improvements over Phoenix Trade is what I feel, but Solana is getting their own native prep decks, and this is good news for them. So they are shilling that off, and people who are already trading on Solana even mentioned that Pacifica and Bulb Trade are other platforms which performs even better than Phoenix Trade. So these 3 trading platforms are getting renewed focus on it. And as you know, Hyperliquid is like world's #1 liquidity place for crypto perpetuals. So everybody, like every chain, every developer group is trying to take some popularity away from it. So everybody is competing with Hyperliquid, and they are always pushing new products on their own chains which would compete with it.
So with all the 3 segments that we have covered up, we can conclude that this isn't just about the new products, it's a complete new shift. So Memecoins now carry leveraged trades, platforms now profit from losses, and pets sit underneath all of it. So which means that risk isn't obvious anymore, it's built in. So first understand what you're holding. So with all these notes, we are winding up on this week Block Talk podcast, and stay tuned for further updates. Bye.